All right, welcome back everyone to our 37th edition of our weekly Wook and Review broadcast. I'm Wook Capital Management Managing Director Rod Alsman. I'm joined by JP Park and my team here. We're going to go through our prepared materials that we have today pretty briefly. Just going to get this disclaimer out of the way before we get into the content. Before I read the disclaimer, if you're following along live, I do have the audio and video available in our Wook Capital Discord voice chat. I'll be sharing my screen as we review different articles and information. Of course, though, if you're just tuned in on Spaces, audio only will work just fine. So, Wook Capital Management, Inc. and its employees solely provide investment advisory services to family clients and do not provide investment advisory services to the general public. Furthermore, investments are highly speculative in nature and involve substantial risk of loss. We encourage investors to obtain advice from your professional investment advisor and to make independent investigations before acting on information that we publish. We cannot assure you that the information is accurate or complete. We do not in any way warrant or guarantee the success of any actions you take in reliance on our statements or recommendations. Past performance is not necessarily indicative of future results. All investment decisions of an individual remain the specific responsibility of that individual. Okay, so for this week's Wook and Review, we've got just a couple of items that I'm going to very quickly go through before I just open up the discussion to whatever folks want to talk about. Just as a reminder, I participated yesterday in a Spaces that I hosted on my personal handle where we touched on a lot of these themes. It was a Spaces that went on for a little under 3 hours, as well as our open mic on Wednesday. We touched on some of these, so I'll do my best not to be repetitive. And I think that for that reason, we'll wrap up probably around the top of the hour today at 5, depending on how much engagement we get. So I'm just pulling up and I'm sharing the most recent newsletter, which I do have pinned here. Oops, pulling that up on my screen now. But you know, there's a few big items out this week. Obviously, the Federal Reserve decision to skip, as the chairman himself Freudianly slipped in. So Federal Reserve policy, though, is expected to continue to tighten. At least that is what they are telling us, and that is what they are projecting in their current summary of economic projections. The equity markets, though, are largely shrugging off this idea of continued tightening, as we saw this ongoing year-to-date rally in technology and NASDAQ continue. Just from a spot check, it's June 16th today. We have Monday. No market trading will happen due to the Juneteenth holiday, so it's a short week next week. But we go into this as we near the end of the second quarter and the end of the first half. The NASDAQ is up just shy of 38% year to date. The S&P has started to close some of that gap. It's up 15% now. And IWM has rallied meaningfully month to date in June as this year-to-date rally has broadened out somewhat, with the small caps up also about 7.33% year-to-date. So all of the major indices in the U.S. are up year-to-date, of course, led by mega cap tech. Now, the Fed doesn't put too much credence and shouldn't put too much credence on equity prices. If the chairman is asked about that, he'll often demur. Not really within their policy target, right? Their goals are stable prices and maximum employment, both of which, of course, pull in different directions at times. So I think the Fed decided to take this pause because we had the banking crisis, which turned out to be less of a crisis. I mean, we're 3 months on, and it's pretty consensus, the view that credit is tightening further as a byproduct of the banking issues in March. However, despite the failure of 3 large banks, the impact that we've seen yet has seemed pretty minimal on the real economy. And while there's concern around office and other aspects of commercial real estate and how that might impact banks going forward, for now, though, the Fed decided, let's take a breather. Let's let another month of data come in. Let's see what the other central banks around the world decide to do between now and then. The implication, again, from the dot plot is that they'll hike 2 more times. So the market does expect, or at least what's priced into the futures, Fed funds futures market does expect, it's about a 74% chance currently priced in. So about three out of 4 chance of a hike in July, which is up a little bit day over day and up meaningfully from a month ago. So, the shift is toward somewhat tighter policy, and for now, equity markets are shrugging that off. I've heard a few analysts kind of talk about the view that because the Fed is implying that rate cuts won't happen until next year, that the market is really honing in on. The market is looking ahead 6+ months and saying, all right, in 6 or so months from now, the Fed will be cutting because they've told us they'll be cutting in 2024. So remains to be seen why they would be cutting, right? Typically, they'd be cutting because there's been some deterioration in the real economy. The rates, they've decided are tighter or are restrictive enough that they're on pace to achieve their inflation policy goals, as well as they don't want it to be so tight that they're unnecessarily inducing labor falling off. So I think that the easy part for them is done. This is going to be the hard part now, and we'll see what happens on the Fed side. So just to note, we'll have our book club back at the end of the month. So we do it every last Tuesday of the month. So June 27th, we'll be back covering Think Twice on Tuesday at 8 p.m. I have that pinned here in the spaces for our next book club. All of the previous sessions are available on both our YouTube channel as well as our Twitter. If you want to listen to those. Last month, of course, we covered One Up on Wall Street by Peter Lynch, which was, I thought, a very interesting and timely discussion. And of course, the month before that was The Big Short in April on the back of the banking crisis. So we've had a couple good convos in our book club. Would love to see some of you all there later this month. So let me continue down the prepared material I had. American Manganese, or the artist formerly known as American Manganese, the company's now known as Recyclico Battery Materials, but we talked about battery recycling a few months ago, and I wanted to bring up the fact that this is a small pre-revenue company out of Canada that has some patented IP behind recycling scrap manufacturing materials in the cell, and module creation process for these battery cathode plants. But they signed the first joint venture earlier this week. We got the announcement on the 12th that they will be entering a 50-50 joint venture with a Taiwanese chemicals company. So they'll be building a 2,000 metric ton per year lithium-ion recycling plant in Taiwan near Zenith Chemicals' nickel sulfate facility. So it's a pretty complicated JV. It's their first deal. I'll just kind of recap briefly. I don't see some of the Recyclico folks who I didn't pointed out that we'd be talking about it today in the conversation yet, but we may actually have Zarko, the American or the Recyclico CEO. I'm going to participate in a roundtable discussion with him in the coming weeks is the plan. So look forward to asking him more details about the joint venture, which, again, is a 50-50 JV. The company is contributing cash as well as its intellectual property to fund its portion of the joint venture. There will be a royalty on product sales from the joint venture, which the company didn't quantify yet. But again, just continuation of what we've been talking about, a lot of investment into different aspects of the electric vehicle manufacturing ecosystem, in this case, the manufacturing scrap for batteries. So very interesting stuff. As an owner of the stock in my personal account, I was pleased to see it and look forward to potentially talking to Zarko and hearing more detail. We'll do our best to, if possible, publish that. Still just figuring out the details and how we're going to host that conversation. I'll continue. Last kind of 2 points. I wanted to talk through. We've got, I talked a lot yesterday and Wednesday about freight and why, for all of the excitement that people have about technology companies, there's a lot of data kind of on the freight side that's not so exciting. Um, Inbound container imports, for example, continue to be weak and are expected to continue to decline into the second half of 2023. So remember, the US imports meaningful volumes of its goods from China and the rest of Southeast Asia. Those imports often flow through the ports of LA and Long Beach. We did get um, a tentative agreement between the union workers at the ports and the port authorities. So that's tentative. It hasn't been finalized. It has to get voted in favor of by the union workers. But the good news there is there won't be a shutdown, which could have been potentially very disruptive and devastating in the Southern California ports. So, while that's great that that's been staved off, just kind of calling out that you still have import levels trending around 2019 levels, which on an absolute basis doesn't feel terrible. But then when you consider how elevated those import levels were in 2021 for much of 2022, it's still causing a lot of pain for folks who operate in the freight sector, whether it's ocean freight, um, whether it's on highway freight. We've talked extensively about how low spot truckload freight rates are and this ongoing rationalization of capacity in truckload freight because of so many folks entered the industry during the boom years. There's unfortunately bullwhips, go to one extreme and then they snap back to another extreme. And we're still, I think, bottoming out in terms of kind of freight demand and goods demand in the U.S. There's a report called the Logistics Managers Index. It's a newer report. It didn't begin until 2017, so it doesn't have many cycles to rely on. But that report, in its latest print, had its worst print in its history. So, there's a mix of both transportation and logistics in there. And of course, warehousing markets are going to vary a lot depending on where you're talking about. But broadly, retail inventories are still elevated, wholesale inventories still elevated. These companies are having to work through inventory, which means that as we continue this destocking cycle, that's why we're seeing this expectation for weaker imports in the second half. So I follow the publicly traded freight companies closely. JB Hunt is a major transportation company that's exposed to a variety of sectors, and their CEO just mentioned in a conference last week, they're still just not seeing those signals that would give them confidence that there's some resurgence coming in the back half. So that's kind of in line with what I've heard some of the other major players say in freight. So yeah, I'll leave it there on freight. And then lastly, I had seen this story in the Wall Street Journal earlier this week about profit squeeze, which I thought was a good read. The headline, the article came out on the 13th. The headline was "The Profit Squeeze is On." And what it talks about is companies will often report these adjusted earnings results. They'll back out one-time items. So they'll say, yeah, maybe we had a restructuring charge, but that's a one-time thing. So let's back it out of our adjusted results. Well, all that noise leads to what I thought was interesting, a Commerce Department report that show when you adjust for inventory valuation and capital consumption, that after-tax profits as a share of GDP have fallen back down to the lowest levels since the beginning of 2016. And obviously, 2015 into 16 was a really challenging time in the oil patch. There was a lot of decline in kind of the manufacturing side of the economy. So it's interesting to see that corporate profits, after-tax profits, are down to those levels, and it's being driven by wage and salaries squeezing profits, which has been a long-standing discussion we've had about if wages and salaries continue to rise, at 5+% clip, it's not really in line with what the Fed wants to see for stable prices. So, continuation of things just being a little bit too hot for them to like. That goes back to what I said at the onset, that it's likely they will continue to raise at least one, potentially two more times, although the market is, for now, calling it a bluff. So that's really all I had prepared. Got through it pretty quick. Didn't want to be too redundant from what we talked about Thursday and Wednesday in the other spaces that I hosted. So I'll pause there, and folks who want to ask any questions about any of those things, Monative, I see you just joined, and I'd love to hear what you're thinking. I know we talked a lot yesterday and the day before, so what I was saying is I'm done with all my spiel. I tried not to be too repetitive. And yeah, I'm happy to keep this space open until about 5 o'clock. See what we want to discuss, any other topics. Monitor and I were listening in on a Bloomberg Spaces earlier today, trying to hear some of the sentiments towards AI. The story was they had put out an article kind of talking about Microsoft winning in AI, and when you really ask them though, it's like, all right, we know that the Microsoft CFO had sized the opportunity at incrementally $10 billion in revenue in a short period of time annually. Some analysts had decided, well, you know what, we're just going to say 10 times that is what we think the opportunity is. But then when you step back and you realize, okay, so since the OpenAI announcement earlier this year, Microsoft's gone up in enterprise value by over $800 billion. Is that commensurate with the increased profits that we can expect to see them generate from AI? And Mondative asked, and I don't think we got a great answer from them.
No, he punted that one. Look. They were clearly just fanboys gushing over Microsoft. There really was no rationale to anything that was said there.
Yeah, I had seen the story. I'm gonna put the story up on my screen because it was their Business Week Big Take story, and it came out yesterday. So I think that was just having the writers maybe who put it together. But you're right, there wasn't as much substance as I would have thought.
Yeah, me too. It's pretty disappointed, but it's par for the course. I think some analysts should have the guts to to bring that up somewhere in their analysis and say, what, maybe I saw one report out today, new markets or some minor one like that said that Microsoft's run is probably done here. So I think it was new markets this morning. But we need to really have someone do a deeper analysis, right? Even by a growth company valuation, this is extremely rich. I mean,
Yeah.
by ZERP 2021 valuations, this is rich. If you really get to a 10 billion sustaining run rate for a few years. But one interesting thing that they said surprised me, that I don't know, it might have been a few seconds before you came in, Rod, but one statement that what's her name, Gina or whoever it was, made was, in talking to Microsoft researchers, one of the issues that the LinkedIn guy noted when he came on board was that the requests for GPU, if totaled up across Microsoft and Microsoft Research, it was larger than their capex budget. This was before
Oh
their
wow.
investment. This was before their investment in AI. So I took that in for a second, and basically thought, okay, this is extra props for why Nvidia is running. But obviously, that's the sum total of all requests. It's a theoretical maximum that no company will ever approve, right? It's like people will ask for 100 expecting to get 2, right? But it's telling there is a big demand for GPUs. There is going to be a massive cost involved in whatever revenue comes out of this. So people are looking at one side of the equation and gushing, where it might actually lead to a trough in profits and margins for a few years before it picks up again and actually turns into, a sustaining contribution. So who's modeling that?
Right. So I'm looking at. I'd love to know that because I don't have access to their research. I see at least one of the analysts who'd called for an extra 48. So okay, Evercore ISI earlier this month estimated that Microsoft's revenue from OpenAI powered features could hit 99 billion by 2027. So there was a little detail in the story that they were talking about earlier, basically saying that GitHub,
That's 35% of their current revenue. 30% of their current revenue.
right,
Really?
right, right. So that's what I'm trying to understand. The Kirk Materney is the analyst, and he's saying 48 billion in extra revenue from co-pilots for Microsoft's Office app. So I guess the thinking they have is that Microsoft can charge X more per user license because of these AI enabled features in their current technology suite, as opposed to necessarily new products altogether. That's my interpretation. Which again, I don't know. It just seems out of the realm of reasonable.
Yeah, we're well beyond anything reasonable here. I mean, all this tells me one thing. I took some money off the table, but I very strongly feel I've not taken nearly enough off the table here. So, you know, this is, uh, and we're still talking Microsoft. Okay, it's still underneath it all a great company with a solid franchise and potential for great things in AI. What about the other crap that has run that is nearly nothing of that? And what about competition in this space, right? So another question I asked Ed, which he punted, is what's her name? What's that? What's the co-host's name?
Caroline Hyde.
Caroline Hyde. Caroline Hyde made a statement that or Gina, one of the two, made a statement about how Microsoft's deep moat in commercial with hundreds of thousands of companies, and the ability to offer AI capabilities to their internal data was a significant moat for Microsoft and would be a big winner. So I asked Ed, in that same vein, it would be an even bigger winner for Oracle. One, they're starting from a smaller base, and two, they, through their database, probably have more structured data than unstructured data that Microsoft deals with in Word documents and crap, right? So, yeah, of course, they punted that too. So it's interesting, if Microsoft is really going to try and sell on that. I
Yeah.
mean, I bet you Oracle has an equally good sales team in the enterprise side to be able to offer the same kind of service.
Yeah, so I'll add a couple other details from the story that they had kind of pointed out. So they noted that last year, Excel, PowerPoint, Word, the whole Office suite generated about 45 billion in revenue from Microsoft. And as we all know, there's plenty of free alternatives out there today that people could use. So I guess what I would take away is the logic from these analysts that are pumping these very large numbers is that the amount of value from the Office suite that a company and its users can derive will go up by so much that they can take price up by, I guess it could be double or more in a short period of time, and it's a win-win for everyone. But in the story, there's a couple examples. The CEO of Atlassian is quoted saying, "The natural state of large software companies tends towards a winner-take-all approach. We have to be careful to make sure that we don't crowd out new entrants." So, I mean, look, sure, I could see the logic of that the Office suite becomes that much more valuable because there's so much data that Microsoft has access to because of how it's been the the status quo for decades at large companies. But right, if there's new entrants that can come in and offer compelling products, I don't know. I mean, the assumption seems to be that mega cap won't see any disintermediation or any disruption from new players. Do you think there's room for new players in this AI revolution, Monolith?
Yeah, absolutely. I mean, look, it's one. It's always been true that technology goes to big companies to die. It's for a lot of reasons, and then they end up spending a lot more money to buy up a more mature but still fast growing technology just to catch up again, because initially there's and they actually brought out some of it that was interesting, right, which is very well known here anyway, that there's a lot of competing groups within Microsoft who were developing AI tools, and there was a pushback initially before the OpenAI investment was made against, putting that 1 billion initial investment into AI rather than giving it to the research groups so they could, build it. That not built here, not in, not developed here syndrome is very strong in all large companies. So they tend to look down upon bot technology versus home built technology, and it could be 100 times as good, they'll still find reasons to sabotage it. That's very common. But if Microsoft or anybody else for that matter actually starts getting the kind of revenue traction that these analysts are talking about, even a fraction of that, you're going to see massive investments from VCs going into the AI field, much more so than now. And you're going to see a lot more people walk away from the Googles, Microsofts, Facebooks, and Oracles of the world to start this and do this on their own outside of OpenAI. OpenAI is a strange ownership structure, sort of like
Yeah.
Craigslist in some sense, you know so yeah, absolutely. I think that's going to happen, and the faster you see a revenue ramp, the faster this development of startups chasing the dream is going to happen. And you're going to see, look, in effect, it is almost Microsoft versus the rest of the world, because they have a close technology, and Google's more open. So Google has more reason to throw money at open source and try to fend off Microsoft in that way. So it really comes down to whether Microsoft can convince, like you said, companies to double, triple their cost of Office to get what they can out of their own data. So I don't know. I think that's a steep price. I don't think
Yeah.
anybody's. It's the same thing for Adobe. Like, how much premium is Adobe going to get from its current customers, and how many new customers are going to get
So,
they going to get for AI tools? And most of this, honestly, I think is a downside protection than an upside opportunity. What I mean is, if things were to go south in the economy, addition of these tools might prevent loss of subscribers by giving them more rather than bring hundreds of new subscribers in, or millions of new subscribers.
and I think that's the issue that I kind of have is you're right. I think it's for the Adobes of the world, for other software providers, is even with Office Suite. It's not that it's a brand new product per se. It's just making hoping to make the product more valuable and stickier for end users. But how does that lead to extraordinary increases in economic value that you're able to bring into your firm? Like I'm looking at the sell side consensus analyst estimates for Microsoft earnings per share looking out. And what I don't really understand, or what I guess is hard to understand, 3, 24, 25, 26, all of the estimates are actually at or lower than they were at the beginning of the year. So it's a little difficult to kind of reconcile that analysts are still estimating the same or actually slightly lower earnings levels in these out years, yet we've seen this massive amount of value added to the equity. So I don't want to say it's just people racing in and chasing the narrative, but if earnings aren't estimated to be going up, at the end of the day, that's what you're buying is the future earnings. So it's a little surprising to see the sell side analysts that cover Microsoft, not marking up out year estimates.
Yeah, we have this is my thing. We have way too little information to justify an actual model for AI revenues in the first place. Where are they throwing out 100 billion, 80 billion? I mean, it makes no sense. It's a feature, not a new product, really. I mean, it's a great feature. It could be very valuable, but you know what? If we get into a recession at some point in time, let's say 24, 25, whenever the heck that is, you know, these subscriptions are the first things that get cut, right? I mean, Microsoft in that sense might be stickier than an Adobe, for example, where you have, I've always had this problem understanding Adobe, and I used to work there. I was there during the entire transition between from boxed licenses, perpetual licenses to subs, and the point was that there's a small percentage of users that are on these digital tools all the time. They need it, and there's no question about it. And then there's another percentage, much larger. Let's say that 10% of the customers use it every day, all day. Another 20% maybe use it once or twice a week, maybe once or twice a day, maybe, right? So that's a third of your users. The other end of it, there's a third of the users that get it because they are a certain level in the company and they asked for it and they got it. And then there's ones in the middle that use it anywhere from a couple of times a week to a couple of times a month, right? So that tail of it is an easy cut in expense when things get really bad. Now, if you offer more and more with the tool, the chance that the the heavy user base grows from, let's say, 30% to 50% or 60%. That's a great thing for the company. That makes their overall numbers stickier. But there is still going to be a percentage that's at risk, right? With Office, less so. Everybody sort of uses it. But if things get really bad, I
Yeah.
mean, there's plenty of free versions available, right? Including from Oracle that, is trying to hit up the same guys claiming that their GPU cluster is the fastest in the world, right? And they are the ones that have a direct relationship with Nvidia, right? You saw all that in their earnings 3 days ago. To say that, to anoint Microsoft the winner this early and to claim that they're going to get 10 billion a year or 100 billion a year, which is just ridiculous. It defies explanation to me. I'm sorry, I'm not ranting here.
No, you're fine.
I'm still trying to understand this.
Mandev, I wish I could understand it. I don't, I think we probably just have to acknowledge that the idea is what people are so enthusiastic about, and many times they're not really, I think, getting to that level of analysis that let the fundamental numbers drive their decision making. I still think it's more of a narrative driven, and to some
Yeah,
extent, yeah.
I mean, if Microsoft really gets $100 billion a year revenue out of it, I would bet my
Someone else has to be losing that,
no,
right? Like
my
that.
entire, I will bet my entire portfolio going, long on Nvidia than Microsoft, because if Microsoft, if this market is really that large, there's no limit to what Nvidia can sell.
Sure, sure.
It makes no sense going after Microsoft if the money is being made by the guy who's going to sell it at whatever cost that he charges.
And I know you've mentioned a few times that right now people are just willing to say to Jensen, "Shut up and take my money. I need the latest and greatest. He can charge whatever he wants to to them." But
Right.
that's not going to
I'm
be the
not
case
even
forever, right? It'll be the
yeah,
case for several quarters.
I'm not
And
even thinking there's an actual revenue this year for anybody from this other than Nvidia. And if people are talking 10 billion, 20 billion, or whatever that number is, then we are undervaluing Nvidia by a lot.
don't tell me that. I need to get out of my short.
Seriously, I don't have a position, but you know what I'm trying to say, right? The point is, the only company making real money today in my calculation is Nvidia, right? Real money from this AI, because they're building out the capability for processing it. If Microsoft has to make 100 billion a year, oh, forget that, right? 10 billion. Let's just take the company's number. If they're going to get to a 10 billion run rate, there's got to be significant investment in hardware to be able to do that. And right now, there's one play in town, and that's Nvidia. So maybe this doesn't end in 2 quarters; it ends in 5 quarters, 10 quarters. I don't know.
Yeah,
I'm
yeah.
just thinking aloud.
Right. Is this where are we? Is this still just 1998?
Well, yeah.
And we can run all the way till March 2020, 2000 rather.
I'm telling you, after I heard that space, the only thing I could think of was, God, I got to sell faster. Everything in tech.
Look, you don't have to catch the top, but I mean, it goes back to your point. If you can't if you're a fundamental oriented investor and that's how you think about placing your investments and adjusting your investments, and you don't see a fundamental case for some of these moves, it would be irrational, right? To just hope that they keep going up. But you know, it also doesn't necessarily mean you'd have to try to jump in front of the train and short or stop it. More so, I'm very fascinated to see. It gets back to the broader market discussion around: will there be a broadening out? Will you start to see energy? Will you start to see healthcare? Some of the stuff that's not been been AI driven year to date. Will that start to really participate? Will you see technology cool off, the inflows into the big tech companies? That's what we'd like to see if one is of the mindset that it's a sustainable, durable rally, and that the market is not just getting far disconnected from the underlying real economy. But no, look, we were talking about freight. I know a lot yesterday. We talked about it earlier, and I just don't yet see enough evidence of that. And I tend to think the back half of this year, really into the holiday quarter, and really for me, it's with that toggling back on of a lot of folks' monthly loan payments. What does the consumer resilience look like there? Because I know a lot of analysts have also kind of projected that excess savings will be for most wiped out by the time we get into the fourth quarter. So it's going to be, to me, that's it, right? Can we keep seeing this
Yeah, I
continued
mean, look,
durability in the consumer?
we could have both, right? We could have an extremely durable, consumer resiliency and an extreme overvaluation in tech, which is, I think, where we are going right now, right? I mean, consider this, right? there's two poster children for AI right now, and that is Microsoft on one side and Nvidia on the other side, right? We've got earnings. Microsoft's is probably 6 weeks away. Okay, roughly 6 7 weeks away, roughly. Okay, give or take. So we've got 6 weeks before this thing could, turn around like we've not seen since COVID fall, right? Imagine one of them, right? Let's say Microsoft is first of the two to report. If Microsoft does not have an Nvidia like projection for next quarter, we're gonna have the mother of all pullbacks.
Heard it here first, folks. MOAP B, mother of all pullbacks. Not to be confused with MOASS.
And the worst part in all this is I'm the bullish guy in this room, so
But look, I mean, it gets back to you need to separate being bullish on the underlying technology, the ability to create profits for the companies, and then where those valuations reside today. And those can get stretched pretty far from one another. And that's kind of where we are. But Baron and Steve, you both came up. Johnny, I'll bring you up as well. Baron, you came up. If you want to chime in, ask Monative or me, and then we'll go to Steve and then Johnny.
So yeah, thanks a lot for letting me speak, Rod. So yeah, hi Monative, hi everyone.
And Baron, one sec. Just before I let you get going, I'm gonna cut the space a little shorter than usual today. My car has been in the shop, and I have to pick it up before 6 o'clock Eastern time this evening. So I'll probably cut it off in the next 15 to 30 minutes. FYI, just heads up, folks.
Okay, so yeah, I mean yesterday, like continuing on the same discussion, what Monative was saying. I think if all these companies they start like buying up, ramping up on capex for GPUs. Don't you think we are going to see some sort of things that we saw for Meta, like where just because of the big capex, the cash flows like dropped heavily. So can we see the same thing for like maybe AWS or for like on margin fronts they are going to see pressure if they are really buying all those GPUs on such high prices, and we saw that with Meta. By the way, today Meta closed the gap. Last year it opened up the big gap from 2022. It just closed that gap. So any views on that would be well. Thanks.
Hey, I'm sorry, I got distracted there. You're talking about look, I'm not a technical trader, so I
No, no,
look
no.
at.
I am saying, Monite, I was referring to the same thing you are saying. Like, if they are buying all those GPUs, don't you think like they start seeing some pressure on margin front? Because
Hell
if
yes, hell yeah, that's my point. You can't manufacture computational revenue without computational investment. And if this is a net new ad, you are going to bring on resources like you've never before done. The cost of a CPU based system is cheap because these guys have designed the heck out of it and optimize the shit out of it to a point where they don't even fix anymore. I don't know how many guys are aware, right? When Google or Facebook in their data center lose a board, they don't look at it. They just toss it, drop another one in, and it automatically gets installed and pops up on the network. That's it. It is that cheap. Now suddenly you're bringing in $30,000-$40,000 GPU into the mix. Imagine the cost overruns from your budget last year, right? Where the hell was this in the budget before? It was not. This is
but we
exactly the point I'm trying to
but
make.
Yeah. But we saw that capex ramp up from Meta. Remember last year, one of the reasons why Meta dropped so much because they were the first who started because of the IDFA changes and everything. They wanted to get around the IDFA changes through using machine learning and whatnot. So they were the first one who started loading up on GPU cards and big spend on data center. But because of that, their profit margins and even the free cash flow dropped heavily. So my concern is maybe we see some of those things with other cloud service providers.
Correct. So that was what you bring a very good point. I was not specifically looking at that comparison, but you're 100% right. But what I was saying earlier was we're talking the absolute best case revenue side of the equation and running up these stocks 30, 40, 50, 60% in 3 months. Where is any of these idiots looking into the expense side of the equation? How much do you have to spend to get that revenue, and how much of that spend is now? And what is it going to do to the numbers?
I think sell side is just chasing the price targets from the current stock price. So they are justifying the current stock prices like just
Well,
changing them. Yeah.
Well, Baron, I don't know if you were in when I was mentioning it earlier. The thing that confuses me is if you look at Microsoft, Oracle, a lot of these winners that have run meaningfully year to date, but then you look at the sell side earnings estimates for 24, 25, 26, they're either flat or down. So why it's like if you're not seeing earnings rise, um, is it just multiple expansion because of the narrative? What is it?
I think if the stock start dropping, they would find some excuse to also take down their price target. This is how sell side works. I mean, they are just chasing the price. Their price targets are just chasing the current stock prices, and they are justifying that
Right.
through
But it's
their
just strange that they bump the prices without also bumping their out year earnings forecasts, is my point, right?
yeah. I mean, look at Meta, right? Last year they were all when the stock starts dropping, any stock for that matter, everyone has a reason for it why the stock is dropping, and it's the same thing when it starts going up. Everyone has a reason for it. I mean, tomorrow if Nvidia drops, everyone is going to see the downside in it. So that's the way it is.
Well, we were talking about Microsoft and what the analysts are estimating for the marginal revenue contribution of AI oriented items. And what we were talking about at the onset was that, okay, so if Microsoft themselves is coming out and saying 10 billion, then you have some analysts who are throwing out numbers 10x that. I mean, of course, they're not going to throw out and say, "Oh, it'll only contribute 1 billion." They're going to reach for the sky, which we'll keep having that, I guess, until we don't.
I mean, if you look at the technology, how it evolves, like when I remember, I think initially some of when the websites were initially the craze, like the dot coms, there were some websites who were charging to make email. You had to pay for email accounts, if you remember. So, I mean,
Yeah, it was not for a while, for a long time until Gmail came into, and killed it all, right?
yeah. I mean, if you tell anyone right now that people used to pay to
The
receive
idea of
calls.
paying, right?
Yeah, you remember? Yeah, so I mean, if you were a sell side analyst at that time and you had a dot com to model it, you could have just said, ah, look, they are going to have that many email users and they are going to charge so many monies to all these email users, and you could have achieved a price target and justified it. Now the problem is, in a long run, technology is deflationary. So the things, I mean, remember initially when the telecom stocks were craze, I mean, the telecom companies, they used to charge also for incoming calls you had to receive on your mobile. Now if you tell someone to I mean, here in France, like all the all the telecom packages, they are free, they are almost free, like for 20 bucks you get like unlimited amount. So, and it's roaming free for, internationally for all countries, like all the 200 countries. So, in long run, in 20 years, I mean, maybe they are going to spend a lot of money right now, but it's all going to be deflationary. Maybe it just results in a chat box from every company, from Adobe, from Microsoft, from Google, and then everyone is going to play through those chat boxes and going to be happy. But I don't see like.
Baron, that's exactly the point, right? We're just trying to understand the bullishness is right now justified for Nvidia for this very minute because they're making so much money from their GPUs. Now, they have to significantly beat that 11 billion to get the support that they've been getting for their stock. If they beat that number and raise it again, it might be good for another quarter or so. Maybe not at this speed, but it'll be fine for them, right? Because people will say, yeah, the story is working and the story continues to work. But any hiccup on any of the metrics for Nvidia going forward, I mean, they're not priced for perfection, they're priced for exemplary perfection. Any hiccup is going to get, it's going to be a, bloodletting of immense proportions on that day when they release that. So same thing for Microsoft too, in my opinion, is the run is so fast, and the street is chasing, literally they're chasing shadows here. There's really no story that is translatable today or even a year from now, right? So they need a better package, and they need that story. If I don't if my thinking is, if sanity were to prevail and we do not get far more details from Microsoft in their earning quarter and guidance, we're looking at a top somewhere here, somewhere, let's say plus or minus 5% of here, is my take. As I hear more and more of this story, I'm more and more convinced that we are in nosebleed territory.
Yeah, yeah. So just again, background before I let Steve chime in, Monative and I were listening to Bloomberg talk about their kind of business week big take on Microsoft. And I think that's exactly where Monative left off, is that there's a lot of hype, but when you really try to dig and scratch, it's hard to reconcile the stock moves relative to the impact on the income statement.
I, yeah, I have also started seeing like some of those tech stocks have stopped going up. If you and they are looking like there is some weakness into it. Like since few days, if you look at Google and Amazon, they're not moving as much, or even they were down 2 3 days. So I think maybe we see some sort of local tops. And but I don't know. I don't know why people don't love Google or Amazon as much as they love Microsoft or Nvidia, because maybe Amazon should also get a business boost if everyone is going to run their workloads for AI. So they should be a natural winner, but maybe they have to spend a lot. I don't know. But
We're already seeing Oracle is getting a boost, right? So it is not that Microsoft is getting the entire AI business like these guys are making it out to be. That's precisely my point. It's like anointing one winner from AI makes no sense, absolutely.
yeah, I mean, I don't know anyone who uses Oracle Cloud, but maybe I think they are growing from a small base. So I think anything incremental is going to have much better impact on their stock prices than, let's say, AWS, which is already like used by a lot of people. So yeah, AWS is already big. I think even Microsoft, like Oracle, is fourth or fifth, and I think they got a boost last year from TikTok. I think TikTok, the government forced them to have a deal with Oracle so that they can service TikTok data. So I think that is the one thing that was bullish for them. And TikTok is a big data set, and it's like a real time data. So I saw that in their conference call they were talking about that whatever they have done with the TikTok servicing business on their cloud side, that gives them confidence to be as good as AWS. But I don't know.
Yeah, they do have some natural advantages, right? Like you and I were talking on DM, right? So they have the entire stack. They have the hardware, the software, the services. That's unique. Actually, none of the other providers, to some extent, Google has, but nobody else. Microsoft has the software, not the hardware. Amazon, yeah, they do with their own design ASIC, but not to the level that Oracle has in depth, right? But you're right. Most of this growth number is because they're coming from a very small base. But the point I was trying to make was you're not going to get 100% of the enterprise all lining up, giving it all to Microsoft. Nobody's going to do that. But the valuation is suggesting that something like that is already, in progress. That's what I'm challenging.
Yeah, 100% right. Even last year, you saw that news with Adobe, like they were trying to buy out a competitor on a very like very high prices. I think it was like 40 times sales, something like that. And then the stock prices dropped a lot, but that deal got cancelled. I don't know what was the reason, maybe because of regulatory concerns.
No, no, it's not canceled. Figma's still going through. I mean, it could get rejected, but it's not done. It's still in, it's still with the regulators. So
Yeah, and when they announced the Figma deal, I think the the narrative was that Adobe is seeing a lot of competitive pressure on their current products, and so they are forced to buy the competitor. Is it like that, or my understanding is wrong?
yeah, yeah. I mean, it's simplistic. I don't want to go into the deal, but it's exactly right. There's a lot of there's a lot of customers that are spending a lot of time on Figma tools, and the competing development tools for that Adobe has was struggling. So it made sense at that time. But this is funny, right? With Firefly and the kind of press it's getting on that, Adobe might be happy to walk away with the breakup fee and not close the deal, just as I think personally, at least in my own estimation, Microsoft would be happy to walk away from ATVI, given that they have so much money that they have to spend on infra to power up this whole AI growth that's coming their way. So it's strange, but yeah, you're right. That deal made sense at that time, even though the valuation is high. I don't think it makes sense now. We'll see.
Yeah, so I mean, in software, like except for Google or maybe Microsoft Office, everything gets disrupted at some time. You always have competitive pressure. I mean, look at Oracle. How many companies, if you just look at the Oracle history, I mean, I think every year they're buying some companies. Even last year they did a big acquisition. S- to remain in business, you always have to buy some sort of competitor. Earlier it was Soft, then there were Siebel, then there were a lot of other small acquisitions. Same with Microsoft, but I mean, some companies they big acquisitions like Amazon and Apple, but except for that, most of them they have to buy out competitors, which creates a lot of so for 5 or 6 years you have big cash flows, and then you accumulate that cash flow, and then you have to buy a competitor to be in business. So maybe that doesn't gets priced in and as expense on expense side from the investors, but it is what it is. I mean, we can't do anything. The market loves tech, so that is the place to play.
Yeah. Steve, I'd like to hear what you wanted to talk about because I've got to wrap this up in about 10 minutes so I can make sure I get my car for the for the long weekend. So,
Yeah.
man.
Yeah. I hope your car is okay.
Yeah, it's a Chevy Volt, and it's a electric component that's covered under warranty. But I always warn people: do not buy electric cars outside of warranty because it's very likely that a module failure or some sort of electrical work is going to total the car on you. And
You sure it's not? You sure it's not an NVIDIA chip that causing the problem?
I don't know if it's an NVIDIA chip,
So,
man. Maybe.
hey, I know. So just real quickly, since I mentioned AMD last week, so I'm just gonna wrap it up with the event. So basically, it's basically what happened is what everybody expected. I think one of the major positives is that that the accelerator platform, the MI300X, it has like 192 gigabyte of wide bandwidth memory, which is triple what NVIDIA Hopper 100 has. That's very impressive. However, here comes the downside because while it looks impressive on paper, it does making some people rising eyeballs because they didn't name any like large scale customer contract, right? So there's no actual detail on how much it costs, when they're gonna actually what's the manufacturing table, because there might be manufacturing logistic problems. Other than that, the software platform, it's like ROCm 5 nm. Like it's also AI workloads. So it's also GPU workloads. But again, so what they're expecting is, so according to Lisa Su, she's expecting the AI. This is the accelerated market. That's a very niche market to 5 times in like say by 2027. So right now it's like 20 billion. They're looking for like to go to 150. So they're looking to gain some market share. But keep in mind, Nvidia's obviously they have over 70% market share in the space. I mean, so people are not very. I guess the analysts not buying it because they didn't like that. They wanted more. I guess they're looking for more than just the product itself. They want more detail. So that's putting some pressure on the company. And today, Morgan Stanley replaced AMD to NVIDIA from their top AI pick. So it's putting some pressures. I've been tracking. So there's a track tool I use. It's Steam, from the Steam gaming software. So they publish data for like GPU, CPU performance for like PC gamers every month. So the latest tracking data, I think for May, you can see the AMD market share for GPU increased about like 60 basis point. And then the AMD's CPU shares, which is, keeping in mind CPU is AMD key competitors Intel. It declined about 70 basis point. It's more like marginalized. I think the biggest contribution, a headline is RTX 4060, like the more standardized commercialized product. It's very cheap, right? $300 to be released later this month. So that's putting a lot of eyeballs on terms in NVIDIA performance. But I mean, I think at the end of the day, right? Like this is a big cake, it's a big pie, right? So AMD is trying to take some shares, but again, it's more a show me story right now. And then I think unlike that sky high expectation that NVIDIA is trying to make for the next quarter, they have actual numbers, right? So if they can match their numbers, great. Because right now AMD is making a 55% second half quarter growth, and then so it's always a show me story, and then the people are not buying it. Okay, if you don't have that actual software, you don't have that product rolled out, just you still have second half year to meet the gap. I don't think it can exist the 50% growth rate, because they already give that growth rate during the earnings call, right? So that's the big gap between those two companies right now. And then I just want to cover quickly on something that we've been talking about all the time. So Bed Bath and Beyond, no, the Bed Bath and Beyond. So
Oh boy.
so right now, so the overstock, right? So last time I was saying that Bed Bath and Beyond, during they're selling their stake, I think there's some other company will be interesting to take a market share. So overstock is trying to pay, like, I think,
yeah, they're the
about like,
stalking horse bid, and it's what, 21.5
yeah,
million for
yeah,
all of the customer lists, the IP, right? This wedding
mm-hmm,
registry. So
yeah,
Overstock has a pretty solid balance sheet. And I think it's a great example of, if you are positioned to be opportunistic when the time comes, in this case, right, Overstock's going to buy for tens of millions if they win, right? We still have an auction, I think, next week, but Overstock's going to be able to acquire for pennies on the dollar
yeah,
Bed Bath's
yeah,
customer lists.
yeah. So yeah, exactly. But the problem is, yeah, so they're gonna gain some market share, right? Because they have like at least, well, like single digit market share in this segment, in this bad home furnishing market. And then today or this morning, the Sixth Street, the private equity, they're bidding as well. They're trying to bid like, what, 300, well, not 300, what was it, like 300 was a couple hundred million for the rest of the assets. So it's in processing, but I think it's just interesting how this thing is drawing down. But yeah, it's I think Overstock could benefit some of it. I mean, they're, keep in mind, I mean, the competitors, like, they have Wayfair, right, and Amazon, but it's a very crowded market. But it will be interesting to see.
Yep. I'm interested to see what the conclusion of the sales process is. I'm seeing now, like 30 minutes ago, this discussion about Sixth Street. So it looks like the story is that Sixth Street is, per Reuters, planning to use more than 500 million of its debt in the company to bid. If other offers for Bed Bath & Beyond's assets come up less than what Sixth Street considers satisfactory, the lender plans to bid in the form of debt forgiveness. So they are the senior lender. So it'll be, yeah, interesting to see what they what they decide, because they do have, I think they are basically they're the senior lender. They'll probably have a pretty big say over what is accepted. I mean, look, it's a challenged sector. There was so much demand pulled forward over the last couple of years. You've got, it already sank Bed Bath, which was for a few of Bed Bath's own self-inflicted failings. And you mentioned Wayfair, Steve, which, they themselves may not survive this whole thing. Their capital structure is pretty shaky. We'll see if they're able to help that with their share price having kind of gotten pumped back up, but it's a tough sector. It's tough to make money, and it's very, this is what happens. It got too many competitors, not enough profit, and people getting put out to pasture.
Well, I think Wayfair can save themselves. They mentioned AI in the next conference call.
Yeah, my AI-powered sofa that I buy from Wayfair and put together myself, the AI is going to actually put it together for me. All right, look, before we get into another conversation, I'm going to have to wrap the call, as I said, a little bit early, so I can go. And unfortunately, AI doesn't work yet to drive our cars for us, but I'm going to have mine back. We always enjoy the conversations. We had some good ones earlier this week, too. Yesterday, we talked a lot. I wish I'd recorded that one. Our little 420 talk. So we had a little 3-hour chat yesterday. We had our market open mic, which we'll have this coming week, which I host on my personal account from 7 to 9 Eastern, give or take. We did that this past Wednesday. We'll do it again. We've got the book club coming, not this coming Tuesday, but the next Tuesday. So we'll be back as well on next Friday with our Wook review. So look forward to chatting with you guys throughout the week. And everybody enjoy the long weekend. Remember, markets are closed on Monday. So talk to you all soon. Thanks again for your interest in Wook Capital. Hope you guys have a great weekend.